Hello guys, and glad to have you on board again today. I'm going to make kind of a weird stuff kind of video, but I had some requests about that and I think it definitely has to be done. So we've made a specific video about EVMOS, very detailed and very deeply grinding everything there is to know about this project, but I thought it was worth it to make a separate one just specifically dedicated to Ethereum users that might already have just heard about EVMOS back then, months ago, and forgot about it, or just you're learning about it for the first time. So I'm gonna make you kind of a shorter version TLDR of what is EVMOS, what you need to understand on the point of view of an Ethereum users. Just because either you have seen EVMOS at a distance, but not in greater detail enough to understand what it actually means and what's its purpose. So we're gonna try digging this. I'm going to use lots of models that I have greater detailed in other videos as well. So really this one, I want to keep it as quickly and essential as possible. So I'm gonna pass on so many details. If you want greater informations and perspectives about that, have a look at the other videos on the YouTube channel. So that's the thing. The current state we're into is that we live in this big world in which, well, lots of farmers activities and stuff like that, and we started to create a value extraction model, meaning that there is a business model that is created around the blockchain technology, and the leader of it, the one who managed to extract the higher value per capita, is basically Ethereum. So we're at the stage in the model that I've been using, which is comparing ourselves and the blockchain technology and its maturity over time as comparing the way cities and ancient cities build themselves over time. When people coming out of different rural areas gathered into specific areas where they created some specific jobs, which specified as well over time into create more detailed craft stuff and so on. They created trades and they started then intercommunicate in between those cities by selling whatever the craftsmen were building in other cities and so on. So this is using this model because I think if there is ever a Web3, then this is what it very luckily will resemble to, because history repeats itself, but it mostly rhymes, okay? So it's not a copy paste, it's just that it definitely looks like. So I use that as a model because I think it is pretty appropriate, and we can already see quite some similarities. Just like back then, everything has been created after the castle emerged, meaning that when we kind of figured out how to extract value from just farming land and so on, this created kind of a separate class which created its own security standards, so building castles. Then very quickly, some kind of a middle class created itself at a clear proximity of this castle, and as time passes they've been sometimes asking for their own subset of security, like building a fort or a fortress around the castle to kind of elevate the security standards of these things. So as you can see, quite some similarities with what Ethereum is today and the layer 2s there has been so much activity that it just couldn't fit inside the castle. The high value transactions weren't able to be settled in between those walls, so we had to create a higher set of walls to accommodate more people transacting in a higher standard of security. So that's the way we're living now. So all of this doesn't exist as for now. It has to be proven right. So this is the model that I followed, and I'm going to go for the TLDR in here, okay? Why EVMOS is critically important, because if this is the model that we use, though this is a clear assumption, like I said, we could definitely not follow a Cosmos model to build this city, and I've explained why I think it is the winning model in that video about Web3. So quickly passing on this, making this assumption that the future of potential Web3 is going to be modified through multiple models, but the leading model should be a Cosmos-like system, then in that perspective, there are two things required to be in the Cosmos gang, and that doesn't mean having Atom tokens at all. The only thing that you have to do in order to be in the Cosmos gang is to use a Tendermint-based consensus and connect IBC to communicate with the others. To make it TLDR as well, what the Tendermint consensus is no more than a delegated proof of stake and that has high composability. So you can do lots of variable things with that consensus. It's very adaptable. Of course, the trade-off is definitely centralization, meaning that every Tendermint-based chain will have hard times overcapping more than 200 validators or 250 validators, because of course, the higher the number of validators, the longer it takes to complete consensus between those things. But what you have to understand is not how Tendermint works. We're going to focus on how EVMOS Tendermint version is built on. So EVMOS is currently running 150 validators, call it kind of an average of what consensus Tendermint can do. So they really didn't go any one extreme way than the other. As a quick example, you've got Binance, which is 20 validators, very intrinsically fast and high TPS. And on the other hand, you've got the Cosmos Hub, who's getting more and more validators and a much more shorter but secure and decentralized blockchain. So EVMOS is kind of sitting in between 150 validators with a 2-second block time. And I think to estimates that I've seen has to be proven, but I think it can perform some thousands of transactions per second. But this is one thing that you have to understand. The Tendermint consensus has one particularity that any other consensus has, is that it's easy to redeploy. It's kind of infinitely copy-pastable. To put it simple, it's not really exactly that, but once again, I'm making assumptions to make this video very quick. So Tendermint can actually copy itself, which means the EVMOS blockchain that there is as an identifier, which helps communicate with it with the famous IBC system. Okay, so in that perspective, it has a chain ID. Okay, but we can basically take this consensus and everything that is EVMOS and to create an EVMOS with, for example, ID would be 9001, and we can create a chain ID 9002, and this will be the exact replicate of the first one. The thing is that we can also very rapidly copy the token distribution. What happens is that we've just have double the same blockchain, which can perform double the transactions per second. These have the same block history and they create the same set of blocks afterwards, or they create their own sets of blocks afterwards. We've just double the performance and capacity of block space, but we also, in that perspective, double the token supply, which means the price of the token gets divided by 2. So what Tendermint does basically is no more than a stock split. So in that perspective, this is what it does. But what it brings is that we have infinite horizontal scalability because we can copy-paste these things endlessly. Okay, so in terms of scalability, you don't ever ask. There are no limitations for Tendermint, or we might find some in the future, but it really isn't a problem today. So scalability is very great in terms of Tendermint consensus. Of course, centralization, like we've seen, is the trade-off. But you still end up with an instant finality 2-second block. And that is something that really matters a lot. Okay, so this is what it is. EVMOS is the bridge there is between the EVM and the Cosmos system, which is instant finality and a short block time with very high throughput transactions possibilities, to the trade-off of course, much greater centralization that there ever will be with the EVM on layer 1. So the thing is, we also need to quickly pass on something. It is a fully EVM equivalent, meaning that this is not an EVM compatibility, just like there is in optimistic rollups or zero knowledge proofs kind of rollups, because these has the inherited security of layer 1 had to make some trade-offs as well. They weren't fully Ethereum standard compatible. So in that perspective, of course, these guys are willingly improving compatibility, but understand it that way. Compatibility means anything that is not 100% compatible. Okay, EVM equivalence is 100% pure compatibility. Everything that is deployed on the native layer 1 EVM can be redeployed in the second environment. Okay, and that also includes all of the tools and services, things that comes out of the EVM. Okay, and there are really lots of things in here. So that's a good point. Of course, I wouldn't even have considered EVMOS if it was an EVM compatibility. So this is fully compliant with EVM standards. Okay, really important. So what EVMOS is, in terms of positioning the entire ecosystem to make it simple, is this. EVMOS is the first Cosmos blockchain, which is fully compliant with EVM standard, while still using the Cosmos gang stuff, a Tendermint consensus, which is well balanced, kind of a mid-ground of whatever else is done in the general Cosmos side, and they're using IBC. The thing is that these IBC stuff is already fully functional. And as you can see from this website in here, EVMOS is already the second one most transacted chain on this network of Cosmos chains. If we look at how EVMOS is currently connected to other blockchain, as you can see, the connections are already there. They're live, they're working as we speak, and they're realizing a shitload of transactions already. So EVMOS is not just a proof of concept, it's a fully functional 100% compatible, so EVM equivalent, that is definitely working in the Cosmos gang already. It's not an isolated blockchain, it already has lots of interactions with native Cosmos chains as well. Okay? Of things and a lot of positive things in here. So we need to go further down the road. So like we stated, there is of course very important things to talk about, and when it comes to this we have to talk about the token model. Why is that? Because there's one thing you probably will come across if you just scratch the surface on EVMOS, is that you will eventually get to these things like the mission control, which is where those who were eligible for airdrop probably have already been passing by, and the feedback that there has been is that for Ethereum users that wasn't an easy thing to claim. So let me be real clear. These things that come when you want to claim the reg drop is that you're going to have to perform some actions in the Cosmos side of stuff, meaning if you are an existential Ethereum users and never ever came across Cosmos, you might have a little bit of a hard time to get there. But the thing is that, well, lots of tutorials out there, because that's the thing. We give you an airdrop, but we also want to teach you how the Cosmos side of the equation works. Remember that EVMOS is in the center of those two ecosystems, and you definitely want to understand how the other way of that equation works. So that's the trade-off. You have to learn how Cosmos works, and if you want to make it easy, then lots of tutorials are available out there. Though that's the thing, the eligibility for this airdrop has been massively large. That's probably the most complicated ever airdrop, and in that perspective lots of people didn't really understand. So if you're eligible, I will suggest you claim. The thing is that from what we can see, there is a bit of a problem in here. Not that many people actually claim. So why is that? Is it because EVMOS is bullshit? Well, I don't think so. We've just taken 10 minutes to explain that it definitely isn't. It is well positioned between two ecosystems that don't have to prove their quality. So in that perspective, what the heck is going on? Well, there has been a hell of a problem, and you probably already have heard about it if you have seen this web page already, is that when these things came up and when the reg drop was claimable just 3 days after the blockchain terminated, it stopped producing blocks because of bugs. And in that perspective, funds were safe. It never has been all about security. Security in Cosmos chains is very elevated. But the thing is that there has been some kinds of bugs, and it stopped working. And it stopped working for several weeks. Meaning that, in my personal opinion, those who had troubles claiming the airdrop simply couldn't terminate the process because the blockchain stopped in between. And that was like the nail in the coffin. That was just too much to handle. Too complicated of an airdrop distribution. No one really knows how eligible they were or were not. How did they got these many tokens and not these? And in that perspective, people felt really confused. But adding to the confusion, there has been, like we said, the nail in the coffin. The blockchain stopping has probably put this into the dead corner of many people. It doesn't work. It looked great on the paper, but it simply doesn't work. That's leave us to where we are today. I think that just 25% of claim tokens explain another big problem that people generally get to talk about when it comes to EVMOS, is that there is a crazy APR. Okay, that's something that stands up immediately to every person out there, and most importantly for Cosmos, for Ethereum users. Ethereum-centric users will say, fuck it, 400% reward, the heck is going on when I get 4% on the beacon chain validation? In that perspective, that means there must be crazy inflation. And yes, there is. Inflation is actually elevated in the first year. That's why we're going to have a look at tokenomics, because inflation isn't bad. You might think it is. I know some people in the Ethereum side of the equation are generally brainstormed to the fact that ultrasound money whatsoever. No, inflation isn't bad. You just have to understand how it's used, okay? So we're going to have a look at it, and by the way, we're also going to explain why this number is nothing compared to the terrible shit and stuff like that. So we're not creating, minting, burning token out of nowhere and stuff like that, okay? This 426% is just mathematically easy to understand if you understand how the tokenomics have been fucked up. Okay, so we have to go straight to this. Understanding what the token model is, and is it translated into actions? Because once again, you can say some things, but what matters to me the most is, do your actions confirm what you said? So what they said is they want to align incentive into both users, validators, and developers. Well, that looks great on the paper. Finally, some cooperation instead of value extraction. Yeah, that's what I like. If we want to get a Web3, we definitely need those things. But still, it's this in the paper, so we'd like to see how you guys handle this in tokenomics. And this is where they've defined something pretty cutting edges, because in that perspective, no one has ever launched in that perspective. 40% strategic reserve. This is no more than incentive for developers. Okay, so the developer side of the equation has 40% of the initial distribution. Tremendous strategic reserve. Rarely seen such a big thing. 10% for the community pool. Well, this is a classic. And 50% airdrop. Like we've seen, airdrop is a big problem because to date, only 25% of it has been claimed, meaning that the 75% of the airdrop that isn't claimed is to be claimed, and there is a clawback that starts on the 1st of August and that will last until the 30th of September, meaning that if by the end of September no one has claimed, or there are still unclaimed tokens, all of the unclaimed tokens will be redistributed to the community pool. Okay, so that's one thing to understand. There could be major shifts in the way the token supply is distributed, because starting in just a few days, the 1st of August, heading into 2 months, there's going to be a clawback in which all the unclaimed token might be redistributed to the community pool. So if this happens, just look how big the community pool will be. Though what you have to understand is that until this happens, okay, the community pool tokens have to require governance votes to be spent, so they're not liquid. The strategic reserve is meant to create a developer incentive, so this is basically grants to programs who develop in ecosystem. Though it is something that will create growth anyway, but this is a liquid supply. Some of this is of course sold by the developers to pay for their expenses, but most of the token are saved for much longer strategic decisions. So most of this is illiquid, and this is for now illiquid. It's in a waiting, it's in a smart contract waiting to be claimed or to be clawed back into the community pool. Okay, so what's left of this supply in circulation is this. This is 25% of half the supply. So this is 12.5% that was circulating at Genesis. Very, very, very tiny supply. You have to understand that the liquid portion of that supply is very low because most of these tokens have been staked, and that's what we see in here. When we look at this thing, the total bonded ratio out of the available supply is 15%. Okay? That's really important for you to understand that number. Most of those tokens in here in the 25%, which is no more than 12% in the Genesis global supply, they're probably all of them are staked, meaning that the available supply for buyers or whatever is very limited. Okay, so this will impact volatility on the price. And when we look at the price later, you will understand why it was volatile. Okay, so the second thing is, boy, like we said, inflation is definitely part of the equation when you have 400% APY. But the question is, well, how much is that inflation though? The inflation is actually this. It's pretty big, but it has a logarithmic decay curve, meaning that the first year we're going to get 300 million issued tokens out of a 200 million initial supply. So that's 150% inflation on year one. That inflation drops significantly on year two because year two will halve that reward, meaning that we will get 150 million out of a 500 million supply at year +1. So the inflation on year 2 will drop to 30%. So we go from 150% to 30%, and it decays very quickly. Okay, we get to a nearly inexistent kind of inflation or controlled inflation at 4 years, and there is a maximum cap supply of 1 billion tokens. So we will reach that level out of 4 years, meaning that the token model will have to be readjusted out of 4 years, because we can't break out of the 1 billion. Okay, though we're going to have to find some kind of a deflationary mechanism to keep on incentivizing validators. Okay, though there is a 4-year kind of bootstrapping model for this token supply, and then we'll have to adjust. Okay, though this inflation staggeringly big, like I said, 150% inflation should make people just run away. So just don't. Give me a second to explain why the inflation model there is in here has nothing to do with the 100% inflation we've seen on AVAX or other things like that, where most of the time these are early adopters or early contributors who have 200x gains and will have vesting schedules, or the team has vesting schedules or whatsoever. So that's not the case, okay? The team has nothing from the initial supply, as we've seen. The team has 25% of the inflation. What's good about this project, and I'll go straight to this, is that the block reward is subject to governance. It can be adjusted by governance votes. So if for whatever reason we decide the team doesn't work well enough with the money we spend for them, we can slash this. We can just pull it down or entirely delete it and just pull that issuance into some other sectors like the staking rewards, usage incentive, and community pool. Though I'll quickly go on this, but I think this is really a staggering thing. I've never seen it anywhere else in the crypto space. These guys have no pre-minted team vesting tokens. The team tokens are basically emitted by every block, and they can be subject to be deleted by governance at any time. So this is kind of a constant vote of confidence that the team is having. If we think they don't worth it, we can just cut them out of the equation. That's really staggering, I think. No one has ever taken that risk in crypto. I like it a lot. Okay, so no security for the team. The team can just jump off the cliff just like anyone else, and that's the blockchain holders who decide. The community pool has a 10% inflation. We had 10% on the initial supply, so it's basically statically going to stay at 10% over time. And this is the crucial part of it. 25% usage incentive, meaning 25% of the huge emission that we have of that logarithmic scale decay is to usage incentive, meaning that this is the token model that makes the thing balanced. Though they really acted according to what they said. This is going straight to the users. What it's meant to be doing is, I think, very simple to understand to a normal constituent human being, is that what this is going to end up looking like is that probably some applications that will deploy will probably be incentivized or granted in some way to just be either gas-free or nearly gas-free, because probably this will incentivize projects which has a necessary need for the ecosystem, or that might have no short-term value extraction model, but a long-term value accrual. And in that perspective, these kinds of change just can't exist without early incentivized kind of grants. And in that perspective, I think that this is what EVMOS can do that no other EVM compatible or competitor can do today. That's the thing. We can create gas-free environments because some projects just can't be profitable on day one. And that's the Ethereum way of life today. If you're not profitable, you're not welcome here, bro. No one's going to pay for you. This is really natural selection. If you create enough value, you're good enough to go layer 1. If you create a bit less value, eventually go for layer 2. But the thing is that you have to create value from day 1. If you don't, then you're not welcome. That's the reason why the current state of the crypto market is locked down to the things that we know today. Things that can extract a shitload of value. The crazy, shitty, $1 million NFT stuff. The DeFi degens. This is what we have seen on the previous cycle of adoption. The next one will have a different shape. I think we have to create different use cases. And specifically, if we go for Web3, we want to have an application type of blockchain interactions where the user, the end user, doesn't know anything about what it actually is been doing. Is using the network for what it is, a network. A thing that is routing either orders or transactions or information in general. And I think information doesn't necessarily have to be pricey on day one. So that's the reason why I think EVMOS has a totally different way of building a business model. We have 4 years to prove it as working, but if it does, then we can incentivize some free use cases. And I think this is definitely important, because attracting user is going to be key in this next growth phase. The next phase is going to be the early majority. So the early adopters were the DeFi degens looking for stupid stuff, but the early majority, they are pragmatists who will adopt innovation. They will look for new stuff, okay? But they will use things that have been proven and they will feel comfortable with, okay? So I think this is how EVMOS has a strong standpoint in here. As it's being fully EVM compliant, it will look like legitimate to these guys because, well, EVM is the standard. At least that's what it looks like. So having this standard in here with an incentivized use case is probably going to bring a lot of activity to EVMOS. The thing is that, of course, EVMOS will never be as expensive as EVM. Like we said, extracting value is 180 degrees of the vision of this project. This project is all about sharing the value in the early stages to incentivize users, okay? And the remaining 40% goes for staking rewards, and that explains the goddammit 400% APR. Okay, we've got 150% inflation on the first year, with only 15% that is taking the 40% cut. So do the math, okay? That's a 150% inflation, okay? Which 40% goes to staking, which only 15% is claimed, because there's only 15% of the tokens that are staked. So do the math and you get the 400%. This is no mint burn shit mechanism, okay? This is just pure mathematics. It comes to the fact that this is absolutely badly handled. Out of this very ambitious token distribution on the initial supply, well, just 25% of it have its claim, meaning that the circulating supply is so narrow that just a few people are actually staking, and they're taking a big pieces of the cake because they're the only one eligible to stake, though only 15% of the token supply stakes on the highly inflationary first year. Okay? So to sum up as a big conclusion, we definitely have what we stated earlier. Okay? There is definitely an incentive to validators with these crazy APR. There is incentive for users, as they will get usage incentive, most of them being through the form of eventually being paid. So what's left with the devs? We've seen that there is a quite significant and substantial strategic reserve of 40% of the initial token supply. So is that all? Well, it's not. That's where there is a totally, I think, innovative model, is that every gas fee in the ecosystem will be deployed halfway through the contract devs and the validators, meaning the validators don't get the whole cut on the fees. They get a 40% of the inflation, okay? But what matters is they only get half of the fees. The fees goes halfway through the contract deployers. So how about an incentive for devs? It's a constant incentive. It is basically in here a meritocracy. This is like the US and the best gold of their ages. This is, well, the more activity you can create, the more money you're going to end up getting. And if you understand the duality there is with the previous model that we've seen, if we first get usage incentive by, for example, paying for a portion of the gas fee or all of it, that means that half of that grant will go to the devs, the rest go into validators. So this is a constant incentive for developers and for the best of them to emerge, because this is proportional to activity on the network. The higher the gas fee, though the more activity on the network, the more you get on your account's balances. So this is something that really incentivizes developers to migrate in an EVMOS environment. So now, if you've got it all, you should be able to understand what EVMOS is. EVMOS is no more than just a nebula, like a nursery for new chains to come and try testing their business model. If they get successful, they'll quickly emerge as being profitable enough to, like we said, stop using incentives and all of these things, but to contribute to the rest of the network. The activity of the network is redistributed and mostly due to these high inflationary first years. So the tokens you get diluted very quickly because you're paying for the other ones who go in. So as long as there is tremendous growth, well, the token doesn't necessarily lose value. So that's one thing. The token price increase might be benefiting to everyone. As long as growth stands out to the inflation, that's definitely going to make it. And I think that the token model that there is in here is very risky, definitely. They are risk-taking, and we've seen that. But the thing is that if it's a model that succeeds and it has all the necessaries to do it, well, in that perspective, this will attract a hell of a lot of new stuff that we can't see ever existing in other EVM environments. Because the others are not necessarily predatory, but they require economic value to be extracted on day one. Otherwise, you can't sufficiently survive. Otherwise, you're going to have to pay through inflation and your token price will head to zero. So that's not what we want to see in here. We want to see contract deployer deploying good business model, viable over the long term, and if they are not necessarily in the short run, we can eventually grant them subscriptions or some kind of incentivization mechanisms, and these things, of course, can be adjusted through governance. So this is really important to understand, because if we go back to what we've seen before, now you got all the keys to figure out what EVMOS is. Okay? EVMOS basically isn't a competitor to Ethereum. It's going to create a hell of a lot of more complex, specialized activities in this city. It is already open network to the rest of the IBC stuff, meaning that some very complex interactions can be created between EVMOS and DEXs, EVMOS and other ecosystems like. And all of these things are already connected. So this is not something like a promise in the future. It's already working. Though there are a lot more complicated interaction that EVMOS can create, not just because of its connection to Cosmos, but to the fact that the business model that's been created in which the value is clearly redistributed in the neighborhood will definitely help to spark a new star into that nebula. These stars, as they shine bright, the brightest of them might eventually even migrate inside the castle and deploy as layer 2 or even layer 1 for the brightest ones of them. So, do you really think EVMOS is a competition type for Ethereum users? I don't think it is. I think it's actually very much complementary, not to say that it's actually going to bring more utility to Ethereum block space or layer 2 block space. So this is really a symbiotic relationship that there is between EVMOS and Ethereum. It's definitely something out there. EVMOS is the bridge between the best of Cosmos and the best of Ethereum. That's really what EVMOS is. Though, if you understand that, you understand that EVMOS has a lot to play. Though the last question I would like to answer is, what do we do with that? If you were eligible for the airdrop and for some reasons you decided to just drop on it because, just like I said, you followed the path, you got in here, you figured out this was complicated, and then the blockchain stopped, so you said, okay, forget about it, this is yet another bullshit project. Well, it's not. It's definitely not. But the thing is that you have to work yourself back there and get to claim the airdrop. What you do with it is entirely dependent on two things. I think you have two options. The first one is either to do kind of a partial redistribution in your personal portfolios, meaning that, well, you just want to sell that thing to just get more Ethereums and the like. If you already have enough Ethereum, I think keeping EVMOS as a diversification in a portfolio is definitely interesting. Considering it that way, Ethereum has already won the battle. The castle is already here to stay. It will be there through ages. The next step of evolution for cryptocurrencies in general, and I would say for blockchain, is this thing. It's to try out Web3. And for now, what seems to be the most used and recognized standard is IBC. IBC is native Cosmos. So that doesn't mean Cosmos will be the choice of the market, but it seriously stands as the most likely probability. So if it is a CT-like model that creates early stages of a future Web3, and if it is Cosmos-based, well, the gate and the entrance and the early activity of these first Cosmos cities will luckily happen in EVMOS, which means EVMOS might be the most crowded and active neighborhoods in the early Cosmos cities. So yes, EVMOS is not a competitor to ETH. It's actually going to bring a lot more depth to this EVM environment in general. That's what EVMOS is. So now it's up to you to decide. Whatever's going to happen next depends on this, because like we stated, currently the token supply is on and headed for 2 very crucial months. Lots of futures can happen through EVMOS, and we're going to try highlighting those and then look at the price charts. So what it is that you've understood that the bigger center problem is this. So multiple things can happen. The first scenario is, well, there's no more claims anymore, or just very limited new claims, which means starting a few days from now, the clawback will start and reduce the claimable amount day by day until the 30th of September, in which whatever is left to be claimed will be transferred in the community pool. If this is the scenario that happens, then this one can create 2 scenarios, okay? So let me sum up this thing, okay? Let me just grab some white lines, okay? So scenario and option number 1 is we get the clawback. This one can create 2 scenarios. The first one being that we decide to retrigger a second airdrop, which is, for example, easier to claim or easier to understand, most simple targeting and stuff like that. So we trigger another airdrop, and we can target that airdrop either to Ethereum. Okay, that means we redeploy those tokens mostly targeted to Ethereum user with an easier kind of airdrop mechanism, or we redistribute to whoever's already claimed, meaning that it is a self redistribution. We take the token distribution and we redistribute the remaining tokens to those who claimed already, proportional to their holdings. That's one way to do it. Okay, that's kind of a second airdrop, meaning that, well, you didn't want the money, we're going to distribute to whoever wants it. I think that if we go for this option, that's detrimental to the ecosystem in its longer term vision. That means the goal for these blockchain is to have adoption. Adoption means users, means participants. So I think the broader the participants, the better. So in that perspective, I think that if we go for a massive clawback, the best will be to redistribute and redistribute massively to Ethereum. That doesn't mean the Cosmos guys will be left behind. I think there has to be a global airdrop. But we definitely have to bring a lot of ETH guys on board, and there's no better way but to airdrop these guys. Okay, option scenario number 2, okay, would be that the Ethereum guys finally learn about this thing. They have 2 months to get in, so they can claim the better, the more the better, because what that will do is that will increase the share of the circulating supply, the piece of the pie that is available to be staked. So the first effect that this will have if more people start to claim is that the APY will go down. Okay, so APR will certainly no longer stand at 400%. APR goes down. Okay, so the equilibrium, do a bit of math. Okay, 40% of the inflation goes to the stakers, so it goes basically net-net with the inflation if 40% of the supply is staked. So as long as 40% of the supply is staked, the APR will be equal to inflation. That means inflation is not destructing your purchasing power. It's just maintaining it. Okay? You're not winning, you're not losing. So 40% of stakers is the net-net drawdown for inflation. If we go above it, meaning that more than 40% is staking, then in that perspective, you start to be diluted by inflation, okay? But the tokenomics has been built for this. It's been built for the staked token to oscillate close to, but below 40%. So normally, in EVMOS ecosystem, being a validator shouldn't be diluting your value, okay? You're not going to gain from staking. It's just that the inflation doesn't dilute you. That's, I think, the initial goal for this token supply, to reach out and 10 to 40% of staked tokens. That's a good level for security in tender mints. That still leaves 60% of the remaining tokens to serve as gas fees, incentives, strategic reserves, community pool, and liquid supply to be traded on exchanges. Okay, so that's interesting. Though we've got these things, okay? And the third one would be we have a massive, like a massive claim, and people sell. That would be the biggest problem, because if people don't stake, so if people claim and sell, what that will do is that will seriously increase the sell pressure, because lots of people will go in and sell to get Ethereum or whatever it is in return. And the question is, if the token drops, if the price of the token drops, that might be eventually incentivizing early users to jump off the boat. So that would be, I think, a bad situation. So that's the reason why I wanted to educate Ethereum users as much as possible today, so that you guys can choose. If you decide to claim because you were eligible, these are your two options. Either you stake, you're going to lower the APR, but you'll never get diluted. You're just going to get a big piece of a cake. That's free money, basically, folks. Option number two, you get to sell to concentrate again on full Ethereum value extractive model. That's really what it is. I think that there will be tremendously much more growth and adoption in EVMOS. But the thing is that this will not extract as much value as Ethereum could do. So, yeah, the matter in here is that we need to figure out what the token model and this adoption model could look like in terms of prices. So, of course, in here we go a bit speculative. Yeah, but here is my model for Ethereum. I think Ethereum has bottomed already. I've already explained why. Might be right, might be wrong, I don't care. But here is the value area for me. I think that we'll get there first, probably gonna overshoot or something. But I think over time, Ethereum's market cap should pretty much stabilize in the $1 trillion plus area. Kind of $1 trillion being the norm for Ethereum. So that's what I think. Out of the current standards of valuations, meaning that we're currently traded at a 200 million market cap, if my memory is right, I'm just gonna make sure of it. Yeah, 179. So consider it that we're rounded to 200, okay? And we go right up to $1 trillion, and we account for Ethereum transitions to proof of stake to kind of put it into a stagnant inflation model, so not necessarily deflationary or not so much. That means, well, Ethereum should be somewhere around $9,000 mark. So out of current level, that's a 6x approximately, okay? So just put that in one piece of our minds. Though, of course, Ethereum may provide a 6x plus gain, and it's almost, it's very, very likely, okay? So that's one thing. You've got a very significant chance to go 6x from current prices, okay? Though when it comes to EVMOS, EVMOS, of course, has a lot less history to prove itself, so we're gonna have to go for our chart. What I've done in here is that I've created kind of ghost candles with the historical prices we had so far. So don't get me wrong, that's why I warned you already, don't be dumb enough to go for triangle stuff or things like that, okay? Illiquid supply means that there is no speculative behaviors in here, okay? Don't do your usual price pattern shit. Just make it easy on you guys, okay? Just take on the rough average value. I would say anything between $2.20 to $2 looks like it is where prices tend to settle, okay? So call it the average price. Though in that perspective, if we account for, let's make it simple, rounded $2 mark for these things. Though the question is, what could be a relative price for EVMOS against Ethereum? Well, like we stated, the economic model is totally different. The way the value circulates in EVMOS economy is much more value-driven type in Ethereum, and it's more incentive user creation in the user and developer creation in EVMOS. We redistribute most of the value that could have been extracted one way or the other, okay? There is big inflation as well, though there is token volatility in the early stages due to the illiquid supply. And on the second stage, what we'll get is a lot of downside pressure due to the high level of inflation, okay? As long as growth doesn't outpace inflation, the price of these tokens just can't rise. There will be a lot of dilution power, okay? So it will only break out. Only will break out if the growth outpaces inflation, okay? Which we've seen may happen early next year, Q2 next year. This is where inflation will drop from 150% on year one to 30%. So expect the market to anticipate that by 6 months. So I think if there is a breakout on EVMOS, it should happen somewhere in October or November. 6 months prior to the slashing of the inflation. Of course, early numbers should suggest that growth is already showing signs of existence and stuff like that, okay? So speculators don't anticipate out of nothing, but consider that generally speculators are getting 6 months ahead of the market, or 3 to 6 months. So I would say anywhere between October to December is the potential susceptible area for EVMOS to show signs of strength. Until then, it's going to be complicated. We're going to have to see the supply getting in. So remember the 3 scenarios we've talked about. If we go for a clawback, what does that mean? That means we're still going to have a shitload of volatility. But the value we get per user is going to seriously increase because we're mostly probably going to make another airdrop. So we're going to get more money. Okay, we're going to redistribute what has been supposed to be distributed in the first place. So we're going to get more of the cake. That means the price should remain low, in my personal opinion, but we're going to get many more tokens because 75% of it is still to be distributed. So imagine that what you have today might be doubled in a second airdrop. So that's option 1. I don't think it's likely, but we have to assume that as possible. Second one is Ethereum guys wake up and they finally get to claim their airdrop. And like we stated, they have 2 choices. Either they stake or they don't. If they start to stake, the APR will go down. Okay? The APR will go down and the supply will slowly but steadily liquidify itself. We will have listing on exchanges and stuff like that. In my personal opinion, that means we should oscillate across the $2 mark. There's no reason to go too far away from deviation on that value. So in that perspective, anytime you go way too low than $2, people will buy. Anytime we try to break above 3, and we'll get the hell out of the way. So that basically sets us on a value area with standard deviation out of $3 and $1. Anytime we try to go closer to $1, everyone will buy. Anytime we try to go $3, people will sell. So kind of a return to the mean, equilibrium stuff if there are lots of stakers. What will happen is that, of course, the staking revenues will be pulled down, but we'll still have the same amount of user incentive and strategic reserve to create growth in the ecosystem. So net, I think that we should oscillate across $2 until we finally succeed building a support out of it, because we have early signs of growth. Remember, that's what I personally think, because adoption could be coming from the fact that Ethereum users are getting in instead of selling. If they sell, what's going to happen is that we're going to get a nice price drop. Okay, and then, of course, what is it going to do? If people sell and people buy, that means we're going to get a much bigger piece of the circulating supply entering the market. So we should get a lot of volatility like that, like attempts to get to $2, but $2 will luckily be sold this time instead of bought, and we will have price oscillating between $2 and below $1 standards. Anytime we go below $1, everyone buys or stops selling, and there everyone sell. Like, it will be kind of a shaking hands of weak money going from the big guys into the hands, into smaller hands, and this will kind of create kind of accumulation patterns of Wyckoffs and the like. So in that perspective, I think prolonged market going to the downside if there is a lot of sell pressure, until we stabilize that, meaning that we absorb all the sell pressure. Remember what we said, the clawback ends in the end of September, so there is a big precise timing to understand. In here means whatever tokens were left to be claimed will be over. So the bear pressure, okay, if you pull it that way, is going to decrease like that, okay? Because these are all the tokens these guys can claim, but over time the clawback mechanism will reduce how much they can claim. So the more they will try to claim, the less they will end up getting, meaning that their sell pressure will decrease over time. So if we're really going on that ETH guys claim and sell, well, we're going to get something looking like that. Until, of course, like I said, the bottom is in, because any of those sellers will luckily find some buyers. I myself will buy some tokens. I got the airdrop, but I'm definitely willing to invest in such a project. So the second question is, if you are willing to invest, okay, not just for Ethereum users who are eligible. So if your eligibility is too low, or anyway, if you intend to put capital into this, there's going to be rule number 1, define the risks. In here, if we account for these and following my strategy, this would be the equivalent of the trend channel width. So the trend channel would be $1.50, which means if you're buying right now, the stop loss is at 0. So let's make it straightforward. There's not an option to use leverage in here, okay? Most importantly, in the short run, uncertainty is very high. Okay, there's only 1 out of 3 scenarios which will lock these prices forever and never will be offered again. This is 1 of 3 chances, though this can still happen. Though I think that if you're willing to invest because you have absolutely nothing in EVMOS, no airdrop, I think starting to buy now is making sense. We're far away from deviation, meaning that in my personal opinion, anything that is below 1.5 down to $1 and eventually below is the area in which you want to make your first call. How much? Well, let's make it straightforward. If the stop loss is 0, that means you're on board for something without a stop loss. That means a maximum capped 1 to 1.5% investment is due. If you go anywhere beyond that, that's absolutely outrageously stupid. Okay? So don't go the 200x gamble with leverage trades, I'm going to be a billionaire stuff. This is not what happens with this cycle. Okay, so that's one thing. We've talked about all the risks, so you know how much you can risk, up to 1.5% capital. I sincerely suggest, due to the model that we've seen, understand that the high level of inflation will put downside pressure on the prices until, I think, November to December, which means I think this can only correlate to one price structure, which is the accumulation. So I think settling down some cash for a further second trade, when the prices will stabilize and show signs of improvements, early growth signs and stuff like that, inflation about to reduce 3 to 6 months, and in that perspective, I think the market may show signs of willingness to break out later. And that would be the appropriate sign to go for a second trade, a reinforcement. Net, you cannot ever risk more than 2%. So 2% maximum risk exposition on capital for 2 trades. This one, of course, the riskier one. So I would say if you already have the airdrop, I don't think it's really worth it to take the risk. In that perspective, just be patient enough, save some cash, eventually put a 0.5% investment in here if you really want to, and take on these juicy APRs, and then save on the second trade, which will be far less riskier than this one. That's what I would say. So you have it all. You can make a wise decision now. If you're an Ethereum guy, well, decide on whatever you want to keep it or not. If you keep it, you're going to get a juicy APR, but expect that APR to draw down to some more rational levels. I personally think that pulling it down to 200 and 220% is more rational. That would bring the staking ratio from the current 15% to 25-30%. And in that perspective, I think that's a sign of willingness for Ethereum to open up to Cosmos, which will be a good sign. So that's what I would like to see. Okay, in this intermediate scenario in which people get in and stake, like I said, I think this is the kind of scenario we'll get. Oscillating across $2 with a slightly upside slope as adoption comes in and slowly overtakes inflation. But it's normally not going to be able to break anytime before November this year. Anything sooner than that is inappropriate to me. Okay, so we've got it all. What could be the target now? Because of course, we're going to have to settle target. We've seen that Ethereum's rational targets to me still remains $1 trillion and the like. So anything higher than that is Moonboy stuff. And as we've seen, the next cycle is hugely adoptive, but these guys will not be degens. So I think a 6x on Ethereum is definitely already a good score. So what could we see? I think in terms of speculative investment, we hardly could imagine anything bigger than a 20x. So I think, rationally speaking, the low value extractive model of EVMOS should some way, at least for the first years, I hardly think that we can go anywhere beyond 2 to 3% Ethereum. So getting 2 to 3% of the Ethereum market cap with a such more distributive business model would be kind of, I think, a good distribution area in which you bought in here and you distribute the supply in here. That's what investment is all about. So this is what I would do. So I think if we have ever a success of a breakout, my initial targets for this breakout will be around the $20 mark, meaning that anything that happens, even if we moonboy to there, I will start looking on some partial gains out of the $20 mark. That will be, out of current prices, a nice 12 to 15x, which is cool. I think it's definitely worth the risk. So as we said, the risk is you risk it all. If you go in, you're not going out anyway, and it may tend towards zero over time due to inflation and simply the fact that demand may go elsewhere. But like we stated, EVMOS is in a cornerstone between two very, very interesting ecosystems. One is already proven to be in part of the future, that's Ethereum part of it, so you have to be fully compatible with it, and it is. The second one is Cosmos, which has a very interesting and scalable tech stack for the Web3 attempt. Though don't get me wrong, Web3 isn't going to be there anytime soon. We're just building the tech and infrastructure to make it feasible eventually, okay? So don't be dumb enough to think that Web3 is there. Web3 isn't going to be there. It's going to take years to get there. But we're today building the tech to make the backbone of it. And I think EVMOS is not going to be the only one, but I think it's going to be part of these bones. See you guys later. Hope you enjoyed that video. If you liked, share it to whatever Ethereum users you may know, because I think the Ethereum guys need to hear it. Bye guys.